Hello, everyone. Happy Monday. Today on the final bar, we will debrief on this market's deterioration, really accelerated Thursday, Friday of last week. Exclamation point on the downtrend today. Sort of nervous looking at the charts over the weekend about what today may bring because you have the distribution of last week. We have all of the headwinds that we've talked about in previous weeks, if not months, and the Fed meeting. Clearly, a lot of negativity leading into that big announcement. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using data visualization techniques and the technical analysis toolkit to better understand what is happening around us. I am often asked to justify why technical analysis makes sense, why looking at charts are a good use of your time as an investor. I feel like days and weeks and months like this one are a perfect example of that. What charts tell you is what is actually happening. There's so much time we spend as investors, as market prognosticators, as strategists, thinking about what could happen or what should happen, what may happen. At the end of the day, you're paid not based on should-haves and could-haves. You're based on what actually is playing out. You're paid based on your performance or your analysis over time is measured. Your success is measured based on returns, and that's based on price movements. So let's analyze those price movements and let the charts tell us what are happening. There have been such clear signs of distribution. We've been pounding away on those so much over recent weeks and months. Many of my guests have been talking about sort of a negative perspective on things, just given the weight that we've seen on the charts. You're seeing that play out yet again today. So we're going to look at a little bit of the short-term movements, but also some of the longer-term downside projections we might want to pay attention to on things like the S&P and elsewhere. We have great guests on the show. Just wanted to give you an update on who's coming this week. Tomorrow on the 14th, we have Miss Schneider from Market Gauge. On Wednesday, the 15th, Dana Lyons from J. Lyons Fund Management and editor of the Lions Share Report. On Thursday, the 16th, Cliff Droke from Cabot Wealth is going to be joining us. He's an expert in gold and materials. Really interested to hear his take on gold, given that a lot of people in this sort of environment sort of naturally gravitate toward gold as a defensive play. Let's see what he has to say. Then I'm taking a bit of a break. I'm actually taking the family out on a bit of a mini vacation. So this Friday, the 17th, we'll be doing a special event, Best Practices for Trend Lines. Really important thing to pay attention to now, as many trend lines have been broken. That'll be a good indication of when things rotate to the upside. Early next week on the 20th, we will be off for the Juneteenth holiday, but we'll be airing a special next week on learning from market history. Also, want to let you know about my newest webcast coming from Market Misbehavior tomorrow on Tuesday, June 14th, 1 o'clock p.m. Eastern. I'll be doing a special event on defining the market bottom and basically the market bottom checklist. What are the things we want to pay attention to, the guideposts, the markers we want to pay attention to help us understand when a bottom is in place? I would argue we haven't seen any of those things yet, but you'll see what's on my checklist and we'll go through and build it through the course of our discussion together. Go to marketmisbehavior.com/market bottom to sign up for that free upcoming event tomorrow. Let's continue on with our market recap. Let's talk about the market environment using stock charts. There's a lot to talk about here, and a lot of red and very little in the green. Let's talk about what that means on its own. The S&P 500 finishing the day down just below 3750, finishing really toward the lows of the day, sort of bounced a bit around lunchtime, but then continued and made one more leg lower going into the close, so right around 3750. This is below 3,800, which has been a key level we've talked about. So that 3,800, 3,825 level we've been keying in on for a while now. That's a Fibonacci level. We've now broken it. I think that clears the way to further downside potential. We'll identify some of those levels here in a few moments. The NASDAQ leading the way lower, down almost 5%. With the NASDAQ composite down around 10,800. The VIX continue to push higher. What's so interesting is even as the market is selling off, the VIX is not above 40 yet. 40 is one of those levels that a lot have keyed into. 35 to 40, we're still not even there. So if you're looking for a sign that the bottom is in because the VIX has spiked up, hasn't gone that high relative to where it has been in previous bear market cycles. Other asset classes here, very, very quickly. Interest rates really pushing to the upside. There's been a lot of discussion here in the last week about what this week's upcoming Fed meeting will certainly look like. Originally it was a quarter basis point, then 50 basis point cut was sort of a rate hike, was sort of priced in. Then it's sort of between a 50 basis point and a 75 basis point. And now I'm hearing talk about a 100 basis point hike being potentially on the table, not from the Fed, but from speculators and market strategists that's thinking about what the Fed will need to do given the sort of free fall that feels like the equity markets will be in. Again, I don't know if that is reasonable that they would be hiking rates by 100 basis points when 25 basis points seemed pretty extreme not too long ago. But certainly this will be a week of the Fed taking some significant action. There's going to be a lot of volatility and a lot of movement certainly coming out of that meeting. Going into it, we'll see what sort of stabilization. Usually it's a quieter period going into the Fed meeting, but I'm certainly pricing in further negativity today. Commodity markets overall down pretty good. Gold down 2.6%, silver down over 3%. Oil prices holding in there using the USO, but the energy sector was the worst performer of the 10 S&P or the 11 S&P sectors. We'll get to that in a minute. A ton of red looking at cryptocurrencies, and if you didn't see this, you should look up the news. But basically, one of the biggest cryptocurrency platforms basically limited withdrawals, and then Binance, similar sort of announcement. The challenge that you're seeing with cryptocurrencies are some of these structural issues. We had the issue with the Terracoin, the Luna, being disconnected from its peg to $1, and sort of those stable coins becoming disconnected. That was not too long ago. Now all of a sudden you have crypto trading platforms having to limit access to funds. These are not the signs of a mature market. It's a sign of a market having stabilization problems. And this is the challenge of for cryptocurrencies here. We've often talked during that bull market phase when it seemed like this was just a way to print money. Now we see what happens during a bear market phase. This is really the first real test of some of these cryptocurrency platforms and a lot of investors that have been riding cryptocurrencies higher. Now, obviously, it's a very different environment. We've often said that everyone's a genius in a bull market. The bear market phases are when you identify some problems with the structural nature of different asset classes, of different trading vehicles. This is when your own investment process, usually some problems start to bubble up very quickly when you're not well positioned for certain things. So certainly feeling that weight in cryptocurrencies in a big way to the downside. We're going to get through as many of these charts as we can here. I just want to start with the daily chart of the S&P 500. So we've been keying in on that 3,800, 3,810 level for quite some time now. This is a 38.2% retracement from March 2020 to January 2022. It's also a 61.8% retracement of September 2020 up to January 2022. So that was a real confluence of support levels. That's why the bounce in mid-May made a ton of sense. Now, in just a week, in just 3 days, actually, we have accelerated to the downside and completely undercut that level of support. Now, again, anytime you break a key level of support, it's all about the follow through. So question number one, as we close below 37.50 for the first time in over a year, do we follow through tomorrow? Right? Same thing we told you on Thursday and a Friday of last week. Of course, both of those days, we have certainly followed through to the downside with gaps lower, showing a lot, an evaporation of buyers basically, and the market not able to easily find a short-term floor. Look at how the last 4 sessions really have closed at or near the lows for the day. That's certainly a market in distribution phase, because the end of the day, which is when a lot of the institutions are making their trades, are accelerating the move to the downside. You're not seeing buyers come in on the institutional side just yet. So we look to see what happens tomorrow to see if there's any sort of stabilization. Was there all the negativity worked out and you see buyers come in? If that would happen, I would certainly consider that a very short-term, buy on the dip sort of move. But overall, the trend is decidedly down. We talked on Friday about our market trend model that turned negative once again on the short-term time frame. It's been negative on the weekly and monthly, the midterm and long-term for quite a bit in recent history. So remains in a risk-off mode. And overall, I'm seeing a lot of potential deterioration. A little later in the show, we'll look at some of the other downside support levels we may want to identify, given the overall move to the downside. Just want to take another minute with our market recap to talk big picture here, particularly because cryptocurrencies have deteriorated so quickly. We get a lot of questions about cryptocurrencies and where some bottom might come in, what levels are important. And we've been talking about the 30,000 level for quite some time. That was support from the middle of 2021. That is where we've stalled out on the downtrend for the last 6 weeks. We've now broken that to the downside, which means what's next, right? Which means you have to start looking at previous levels of support. The bad news is there's not a lot below where we've been at because we've been in this sideways range for quite some time. We're in a bit of uncharted territory, pun intended. So my first go-to would be look at some big round numbers. If you look, the last number of sell-offs had come right down to big round numbers like 50,000, 40,000, 30,000, which means 20,000 is only 3,500 points away, but that would be the next big level I would be looking for. Below that, you're going back to mid third, fourth quarter of 2020, which is down here in the 10 to 12,000 level. Boy, talk about a big drop down. That's another 50% drop from where we're at. But if you don't believe that Bitcoin can be going that farther, you haven't been paying attention to the deterioration up until now. Obviously, a lot of negativity, a lot of deterioration, oversold once again, but the path of least resistance, I would argue, from a technical perspective, remains lower. Our next segment is sector setups. Now that we talked about the big picture, obviously a lot of negativity, a lot of price movements to the downside. Let's look at the 11 S&P sectors and how they are trading relative to one another. We start with the RRG, which is the relative rotation graph, shows us the 11 S&P sectors with the S&P at the middle. So this is using weekly data to start with, and you can see that the energy sector, by far the outlier. Again, this is the way that the RRG has looked for quite some time. You can even rewind here by just drawing the mouse back. And what I'm going to do is take it to broaden out the viewable area a little bit. Here's energy on the far right side. Really starting back here. If you look at October, November, December, this is where we were at in the beginning of the year, at the first week in January. You can see how energy is sort of in here with technology, consumer discretionary on the far right. So these are the three sectors that were outperforming the most. And look how energy just took off, separated itself from the rest. So you can see energy going northeast, technology, consumer discretionary going southwest. This is the reemergence of energy versus everything else. This is the value trade working much better than the growth trade. And while energy came down a little bit, it has continued to push further and further to the right. So even though a lot of energy names down today for sure, this is based on weekly closing data. So it's looking at longer term trends in these different asset classes or different sectors. And even though energy has pulled back, it's nowhere near the deterioration you've been seeing in other parts of the equity markets. So it's still energy versus everything else. After that, let's jump in a little bit to the more current data. You can see utilities, consumer staples, materials, and healthcare. Those are the other sectors that are in the leading quadrant. Now, the problem with most of these is that they're heading due south. And that's not the end of the world. That just tells you the momentum is lightening up a little bit. Further to the right means they're outperforming. So that's where the relative strength has been. I often tell people in this sort of environment, it feels like everything is going down, which is what you essentially saw in today's market. You want to stick with things that are outperforming. You want to stick with things that even though the price may be going down, it's going down less than other things, right? It's outperforming, meaning the relative strength will be sloping upwards. And this RRG, the things in the leading quadrant, are generally things where that relative strength is sloping higher. The utility sector, the materials sector, consumer staples, healthcare. This is where we've seen some pockets of outperformance. And even though many stocks are certainly going down on the average day, you're seeing some areas of the market that are going down a lot less. It's the relatively defensive parts of the market. And that's the rotation continuing to point out that is the place to be. What's really not working? Familiar themes here. It's consumer discretionary, technology, and financials. These are the three sectors remaining in the lagging quadrant. The three of these showing much weaker relative performance than the sectors in the leading quadrant. In general, this is where you want to be. This is where you want to avoid. Be in the leading sectors and be light in the lagging sectors. And in general, that's how you're going to probably weather this sort of uncertain market a little better than otherwise. Let's look at the 11 S&P sectors on the candle glance function. This is taking all 11 charts plus the S&P 500, throwing them on the screen all together. Let's look at which sectors look similar, which look different. Now, the first thing that struck me as I was reviewing these earlier in the day is obviously how many of these are now at or near new 52-week lows. This is looking at the last 1 year. Starting in the upper left, we have communication services making a new low. Consumer discretionary, very close to it. We're not quite there, but they're very close. Consumer staples, certainly there. Financials, absolutely new low. Healthcare, new low. We'll come back to energy because it's the obvious outlier. Industrials, materials, technology, real estate, all of those sectors. So most of them making a new 52-week low today. And a lot of them sort of getting very, very close on Friday and heading in that direction. But today, an exclamation point to the downtrend moving to new swing lows. Now, let's focus on which sectors have not made a new low yet. And maybe that's where some opportunities could be. So while utilities have certainly come down on an absolute basis, look at the relative strength, we bring up the chart, and you can see that the relative strength shows this. This is the relative performance of the utility sector since November of last year. So while it's been a choppy chart, and while it's certainly pulled back here, the trend in relative strength is strong. So again, if you just owned utilities over the last 6 months, you would have done much better than sticking in the S&P 500 by far, because you're basically owning an area of the market that's holding up relatively stable prices while all the growthy stuff has been rotating to the downside. Energy is the second sector we'll look at. Here's a relative strength that's been in a nice long-term uptrend the last 6 months, obviously very strong. The XLE pulling back today, right? And again, no small down move. It's down over 5% today. That hurts. Charts like DVN, Valero, names we've been highlighting, giving back some of those previous gains today. So the XLE wiping out the last months of price movement in just the last couple of days. So I know that's a big move. But again, on a relative basis, you're actually doing pretty well owning energy still, even with days like today that are pulling back. So if you have to be in equities, there are areas of the market that are outperforming, and that's where I would encourage you to focus on. What's interesting is the XLE, even pulling back, hasn't undercut its 50-day moving average yet. It's actually still above the 50-day. That's the only one of the 11 S&P sectors that can make that claim. The rest of them all below their 50-day, and most of them, if not the rest of them, all below their 200-day moving average as well. So we talked about utilities. We talked about the energy sector. What else can we talk about? The last one I wanted to highlight, I'm going through the 12 of them, would be the consumer staples sector. So again, while it's been down on an absolute basis, the relative strength is still relatively strong. So just think over the last 6 months, if you own consumer staples, utilities, energy, you're performing pretty well on an absolute basis. Your returns are actually pretty decent. If you had an equal weighted portfolio of those three, that's pretty good. Now, would we all go to those three sectors back in November? Probably not, because that's when the S&P is making a new high and it felt like the growth trade was working. But the question you should ask yourself is, at what point between November and now, you have a 7-month runway, at which point, at some point, you should be recognizing that the trends have changed and that the relative strength is rotating to those defensive areas. What did you miss? If you're not there now, what did you miss along that path? That's what you can learn from bear market phases. Where were there opportunities to get defensive that you may be able to improve on for next time? Let's take a quick commercial break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close as we break down the activity in the markets using the technical analysis toolkit. A couple quick announcements before we continue on with our show. First off, we welcome your questions. We'll do a mailbag segment tomorrow on Tuesday's show. We love to feature one of your questions live on the air. Our email is thefinalbar@StockCharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Tuesday's show. Also, go to StockChartsTV.com. That is our on-demand platform. Such great content. When the markets get crazy, when the markets get uncertain, we have an incredible team of commentators and market experts to help lend their expertise and share their perspective on what is happening. You can access all of our programming for free on demand at stockchartstv.com or on your mobile device. Just search for StockCharts TV on demand. Let's continue on today's show with our next segment, shifting stocks. Let's focus on how the equity markets have evolved from a bottom-up standpoint. From a top-down, certainly a lot of weakness. We've covered that, I think, exhaustively up until today, but certainly more of a follow-through to what we've seen today. Talk about sectors, and a couple of the sectors that have been outperforming. And again, I'd encourage you to focus opportunistically on where you're seeing outperformance. That's the way you ride out this sort of environment. Hopefully a little more smoothly and less painfully than others. Let's look at some individual names. You know, what strikes me as I was looking through stocks over the weekend and then some this morning, some of the names that I was noticing last week, have failed to follow through on breakouts. And again, while we know that the market has gone lower, I think one of the telling characteristics of a bear market phase is breakouts that seem really obvious don't play out, right? Names that you think in a normal environment, you get the buy signal should just be ripping to the upside when they don't. What that tells you is that there just isn't enough appetite for long ideas, right? There isn't enough buying power. There aren't people looking to allocate their funds to new breakout candidates. And that's what does not provide the upside trajectory that these charts actually need to follow through. DAR, Darling Ingredients, is a consumer staples name. It's in the food products group, which has been an interesting group. This is, names like, Kraft Heinz and others you probably know a little better, which we've talked about randomly when the evidence dictates to do so. But if you look at this pattern, it's a cup and handle pattern, but did not actually get the signal to buy, basically, if you follow it. A cup and handle pattern. So if you have a big rounded bottoming pattern, then a shorter, shallower pullback. So you have the cup and you have the handle. So it literally looks like a coffee cup. And you take the rim of the cup here, right? This beautifully consistent resistance level. You break through that resistance. That's your buy signal. Never happened. So the last couple of days, instead of getting that buy signal, getting that confirmation of a breakout, we fail at the rim. So it's a failed cup and handle pattern. And that, again, is a sign of buyers not being available to, buy in. There aren't people looking for, allocating to equities. People are taking the risk off the table, not adding more on. Here's another one. This is a AIZ. This is in the financial sector. We highlighted a bull flag pattern. I was talking with some of our market misbehavior premium members about this name. We got a big run higher. You then have this downtrend, right? A parallel channel of lower highs and lower lows. If you look, sort of the trigger on a bull flag pattern is where you take the resistance levels. So take a trend line. Sorry, that's like I drew a trend line you can't see. That's a little bolder. There we go. So you take the highs, right? So you take this, and then you can see we have this sort of, no, that's not the button. You take, you take the, I'm just butchering the StockCharts platform. Sorry. You take this resistance level. Once you break above that trend line resistance, that's the trigger. And it happened about a week ago. Then we immediately failed, right? So we often talk when you have a breakout, when you have a break of resistance, do you get the follow through, which confirms that breakout is true? You didn't get it, right? So instead of breaking out and pushing on to new highs, we break out, we fail, we come back down. So charts like this, it's one of those things that I've learned to recognize when, just to confirm the fact that overall the sentiment is very negative and it's not a risk-on environment. Charts that should work do not work. And all of a sudden you're starting to think, all right, now we just need to get defensive. Now we just need to go in these sort of the fetal position and ride things out, get defensive, and try to ride out the best that we can. Other ones that I'd highlight, some of the Chinese internet names we've been looking at recently. Baidu is one, and again, not a very different look than some of these other charts, but this is one that just broke above its 200-day moving average. One of the things I note when I'm looking for stocks making new 3-month highs and new 3-month lows, are they able to, they have any key moving averages? Baidu is an interesting one because it's not performed particularly well. And, on a relative basis, most Chinese stocks listed in the U.S. have been struggling on a relative basis. It has a lot to do with broader challenges to the markets there. Strength in the dollar certainly not made it a great opportunity for U.S.-based investors. This is a compelling chart, right? You have a double bottom just above $100 a share. It's starting to show that there's some demand coming in. We break to a new swing high. We get above the 50-day. All of a sudden, we approach the 200-day. The 200-day moving average served as resistance in February and a number of times in March. Can it get above there? closed above there for 2 days, right back down there, on Friday, and then really following through to the downside. So not only do you have stocks breaking down to new swing lows, you have stocks unable to break to new highs. And when I think about some of the conditions that would tell me that this downtrend is over, that first bucket would need to play, right? You need to have stocks, you need to have less stocks making new lows and stocks that are able to make new highs, right? Showing that the demand is coming in here. It's not the case that we're seeing. Just to finish off this segment on shifting stocks, I want to talk about some of the FANG names. Broad weakness in these six, the fan mag stocks, as I would call them. Amazon is a noteworthy one because today's sell-off puts it to a new closing low for the year, but the range is similar to where we had a couple bottoms there in May. So low in May, early May, late May, and now once again here, just above $100 a share. I think Amazon holding 100 would be certainly a key one. Apple making a new low for the year here today, and very, very close to a new 12-month low. It's actually at the price level it was last June. So, again, from a top-down perspective, just looking at the big picture, the trend is negative because we were unable to make a new high in March. After we're unable to make a new high in February, we've now made a new swing low. We've now retested that support level from below, which is around 150, and now we're rotating to the downside. That is literally a textbook on technical analysis addressing support and resistance levels. Should feature this chart. It's such a clear illustration of a rotation from an accumulation phase to a distribution phase. This is the nature of the equity markets right here. And again, I would argue broadly risk off. Today could be the bottom. I would be absolutely surprised if that would be the case. So never say never. But again, I would much rather wait until you see signs of accumulation. You're not seeing that today. We need to wrap the show, folks. Go to the 3 and 3. Let's highlight 3 charts in 3 minutes that tell the story of this market environment. Now, during our broad market discussion or market recap, we were talking about some of the broad market conditions, just the overall weakness in equities. Just want to show you how weak today actually was. 95% of listings on the New York Stock Exchange were down today. That is incredibly unusual. And if you know why, it's because this is actually looking at all the New York Stock Exchange listings. So it's not just equities, it's closed-end funds, it's bond funds, it's random ETFs and things that are all listed on the New York Stock Exchange. 95% of everything closed down today. Looking back, you can see that hasn't happened a single other time in the last year. And while some will say that this is a sign of capitulation, I think it's a sign of incredible negativity. And in extended downtrends, you'll see more and more of days like this as people continue to take risk off the table. So it's too early to say that is any sort of capitulation in my opinion. Chart number 2, let's look at the Fibonacci retracements. If you take the low from March 2020, the high from January 2022, you look 38.2% of the way down. That gives us a downside objective of 38.15. We met that level. We bounced higher. As of today, we have now broken that. I think that actually opens the door to 2 further downside objectives. 3,500 would be a 50% retracement of that overall move. I'm looking more to 3,200, which would be a 100% retracement down to the September 2020 lows. That would be a 61.8% retracement of the way all the way back down to the March 20 low as well. Overall, that'd be about a 35% sell-off, depending on where we would actually find eventual support here. The distribution that I'm seeing, the weakness in breadth, the weakness in individual names, tells me to be emotionally prepared for much further downside and to think defensively. I will tell you when the charts start to indicate otherwise, but I'm not seeing that today. Finally, interest rates. 10-year yield, we had so much to talk about. We didn't even get to the 10-year yield making a new high, but we've been talking so much about the late 2018 high, which is around 325 for the 10-year yield. We broke right through that. On Friday, we bounced above 315, which was getting us closer. Today, we just didn't even look back. We broke right above 325 and continued on to 337, which is a new, 8-year high plus for the 10-year yield. This shows you how much rates have come up, but also I think hopefully should show you the potential of rates from here. Look at the bottom series, which is the relative performance of value over growth. Value does much better in this environment. Rates are going higher. I will be continuing to look at value for opportunities, and growth is just not going to be a good place to be for likely quite some time. Folks, that is our show for today. A wrap to a very busy Monday. It's tough to cover all the different ways we can think of this market, but I hope this was of help. Also, make sure you go to my website, sign up for my webcast tomorrow on bottom checklists for StockCharts.com in Redmond, Washington. I'm Dave Keller. Have a great night. See you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.